Is the Fed too late? It's a question being posed by economists around the world, and markets from the U.S. to Japan seem to be screaming yes, with massive and in some cases historic sell-offs. Brad Bernstein is the managing director at UBS Private Wealth Management. He joins us now. Good to see you, Brad. It feels very eerie here at the New York Stock Exchange given the crash we are seeing from Japan here to Wall Street. That's it. Is the Fed too late?
Well, historically, the Fed is always late. They're either late to start raising rates or they're late to start cutting rates because they react to the data. They're data dependent. So therefore, they're always going to be a little late. Now, is this huge sell-off we've had in 3 days warranted? Probably not. Does it feel like an overreaction to me? It does. But the nice thing is related to the Fed is because of where inflation is today, they have the ability to start cutting rates. And because interest rates are the highest they've been in 22 years, they have a lot of ammo.
All right, let's take a couple of things you said there. One, that they're always reacting to data. Don't we entrust the Fed to be ahead of the curve, to anticipate what's coming?
We hope so. But unfortunately, I think history has proved that they're typically a little bit behind the curve by design because they're reacting to the data as they say. They are data dependent. And, that they reiterate it every time they speak. And I think, it's clear now that it's not, are we getting a rate cut in September? Is it going to be 50? And as some are calling on the street, is it going to be more or sooner than September?
Yeah, want to get to that in just a sec. But first, something else you said. Let's talk about what caused this. Is it Friday's dismal jobs report?
I think it's a trifecta of events. 5 days ago, the Bank of Japan cut interest rates. Raised interest rates, which created an unwind of the carry trade of shorting for hedge funds, shorting the yen, long the Nasdaq. And I think there's just been a risk off. Japan's markets are off about 20% in the last 3 days off of this. And then we had some weaker than expected data, ISM data Thursday last week, and then the jobs data Friday. And then the third leg of this is the uncertainty going in to the weekend and continuing today with the geopolitical risks of a Mideast war.
Okay, Elon Musk, and we will get to geopolitical in a minute. Elon Musk says the Fed was foolish on X for not cutting rates. Now, obviously, Tesla and other companies, all tech companies, benefit from lower rates. But would we have seen this kind of sell-off, this type of panic, had the Fed cut at their prior meeting?
I think that's very hard to say. It's very hard to know what would have happened if they had done it. I think it could have created some panic because if the Fed had cut and they hadn't been predicting that they were going to cut and the market hadn't priced it in, it might have created some panic if they had cut as well. So it's hard to say looking back now what would have happened. But I definitely think, we're due for the Fed to start their cutting cycle next month.
Okay, now let's get to that cutting cycle. Jonathan Siegel, one of the more respected minds in this world from Wharton, he suggested an emergency cut ahead of the September meeting and added to that, at minimum, a 75 basis point cut in September. What do you make of that?
So I heard the professor earlier this morning say that. However, 30 minutes ago, we just got more economic data that was actually better than expected. So the ISM non-manufacturing number just came out at 10 o'clock this morning. And once again, you never want to just look at one data point and extract where the economy is based on one unemployment number or one ISM number, because the ISM number we got today that was over 51 was very positive and it helped the Nasdaq come back about 30-40% of where it was trading earlier this morning. So we don't see the need for an emergency cut. The economy is not falling off a cliff. Whether good or bad, when markets move this fast, this quickly, it's not based on fundamentals.
Indeed. All right. So the Fed Watch tool has a better than 70% chance of a 50 basis point cut in September. That's up from 15% just a few days earlier. What do you predict in September?
So on Friday, we upped our predictions for Fed cuts in this calendar year. We were at 50 going into the end of the year from here. We now see 100 basis points. So we see 50 in September, 25 in November, 25 in December, because the data is starting to weaken and the Fed will want to protect the economy from a recession, which is their dual mandate.
That's major. Okay, so what should investors do given the backdrop you just laid out?
Sure. So number one, always stick to your long-term plan. Do not overreact to a bad week or a bad few days. Historically, the best weeks and days and months come right after the worst days and weeks. So the worst thing an investor can do is overreact and sell. What we are telling our clients today, and what we've been doing today and Friday, is we've been starting to put some money to work into their diversified portfolios.
So is there a particular safe haven as far as industries go, or do you want to lean into small caps?
So we like to be diversified. We actually do like small caps here. They've been incredibly volatile the last 6 weeks or so. They were up 10% in the month of July. They've given about 60, 70% of that back over the last couple of days in this overreaction, in our opinion, in the markets. So we would be adding to quality tech. We would be looking at small caps here, and we would be invested in our diversified portfolios based on our clients' goals and objectives.
One glimmer of positive news here is mortgage rates are set to plummet. What will that mean for housing, and is there an opportunity there as far as investors go?
I think it's huge. I think that is one of the reasons why we love small cap going into the latter part of the year, because it's a levered way to play rate cuts, because small companies are fast growing and they borrow more debt than large ones related to real estate. It certainly should help the real estate market fall. I know, speaking to our clients who are in the real estate industry, they can't wait, and they're on the edge of their seat for the Fed to start cutting, because liquidity is essential in real estate, and this will really help that market. And it's great to see mortgage rates start to come down. And I think that will help the housing market going into the end of the year.
All right, some major news that would ordinarily be the biggest story on the planet. Over the weekend, reports that Iran could attack Israel at any point. How might geopolitical events further impact the instability in the markets?
Sure. So the setup going into this past weekend reminded me a lot of the last week in April, when we actually had our, prior to the last few days, worst sell-off of the year. We were off about 4% the last week of April as the geopolitical tensions were blowing up around Iran attacking Israel. They attacked Israel with the missiles. Then there was a few days where what was the retaliation going to be? And then the market quickly recovered that sell-off. So that's definitely been a part, I think, of the risk-off sentiment in the last few days.
And then there's, of course, the U.S. political situation, which has been the biggest story day in and day out over the past month, with the notable exception of the Olympics. It's completely flipped on its face following President Biden's exit and VP Kamala Harris getting the nomination and raising $250 million. Does any party benefit from the instability we're seeing in the markets?
That's hard to say. I think both parties, I know the Republicans right now are using it to their advantage. I think both parties could use this in any political way they want. But at the end of the day, we still see, despite the fluid nature of this, the Republican sweep, but not nearly as great of a chance of a Republican sweep since Kamala has been the nominee. However, the Democrats mathematically practically have no chance of a sweep. So historically, markets do best when there's a split Congress. So in any event, I don't think either party has a huge impact on the markets unless there's a sweep from one party, which would have, for example, if the Republicans were to sweep, a big implication for taxes with the Trump tax cuts expiring in a year and a half.
Will there be any political pressure on the Fed, or will the markets and the data drive everything as far as their decision?
Well, we certainly hope and we want to believe that there is no political pressure on the Fed, that they are independent. And I think the data and the markets are going to be driving the Fed based on what they see. Like we had discussed earlier, the Fed's data dependent. If the data starts to weaken, they're more likely to do more and sooner with interest rate cuts. But now we have the Fed put back, in that for several years with inflation too high, cutting rates was really off the table if the economic data rolled over. That was a big concern in 2022. Now that inflation is getting close to where the Fed wants it to be, we have the highest Fed funds in 22 years. So they have an enormous amount of ammo to use to help to put protections in for the markets and the economy.
I apologize for not using the word inflation throughout this entire segment, because that ultimately is driving what the Fed is or will do in the future. Are they on target? Do you think they'll hit that 2%?
As they said, they don't need to hit 2% to start cutting rates. They're predicting that they're going to hit that, I believe, at the end of next year. So we're in the high twos right now and probably headed lower. And I don't think it really matters for the markets because the Fed's going to be cutting because they're in a place where they can be cutting in the twos. As they've said, they don't need to get to their target to start cutting.
Yeah. But with that cut not coming until September, final question, what could turn this ship around? What data could come in that stops this sell-off?
So what we've already seen today is we did get some economic data. As I mentioned, the ISM numbers that came out this morning were better than expected, which kind of put a top on the sell-off, and we've gotten a little bit of a recovery. So clearly the most important data for the markets is going to be unemployment, which will have more data points, a lot more data points over the next 6 weeks into that. And I think that, what markets want to see is decent numbers, but not too good and not too bad. What we've seen recently is bad news for the market. So we need a little better than expected news, but not too good so the Fed can still cut.
And a lot of bad news on this board, more than 1,000-point drop for the Dow and the NASDAQ down more than 3.5%. Our thanks to Brad Bernstein, Managing Director at UBS Private Wealth Management. Thank you, sir. Appreciate it.
Thank you so much. Have a great day.